Hello, everybody. This is Wise here. Today we have Lakshay Gandhi, and he's going to be speaking about, how you can be a first if you're a first-time home buyer. How the government can help you with these increasing interest rates. So,
Thank you.
cool.
All right. All right. So let's get started. Let me just share my screen first. All right. Can everyone see my screen now? Perfect. 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 Thank you very much for joining in. My name is Lakshay. I am the accounting person that you want to get towards if you have a real estate brokerage or if you are a realtor. I have two offices in Mississauga as well as one in Brampton. So if you want to reach out to get some help in terms of your year-end accounting, bookkeeping, taxation, I am your guy. So today's topic, I wanted to touch a little bit based on what is happening in the market. With the rising cost of interest rates, a lot of the people are priced out and they're not able to purchase their first home. So if you have a client that is looking for your first home, I have got a few incentives for you to explore to make this house a little bit more affordable. So rising interest rate is causing people to not be able to afford the same 700, $800,000 house that they pre-qualified for. So now this incentive called first time home buyers incentive plan can actually help you in achieving your client's goal, which is securing your first house. So let's get started. Does anyone know what a first time home buyer's incentive is?
RSSP? Oh,
RRSP? Yes, there's something called home buyer's plan, which is where you contribute to your retirement savings plan and you can withdraw up until $35,000 from it without any penalty. But today's topic, I'm trying to steer it towards a first-time home buyer's incentive plan, which is offered by the government. The home buyer's plan that you mentioned is a separate strategy that you can also use, but this is something that will really sweeten the deal. So let me explain to you what that is. So it was launched in September of 2019 and it was revised in May of 2021 as well as last month, June 2022. The first time home buyers incentive plan is basically an interest free loan given by the Canada Mortgage and Housing Corporation, which is called CMHC. It is basically helping new homeowners to basically purchase your first home. So let's assume I wanted to buy my first home and I have 5% of the down payment saved up. But I needed 5 more percent in order to close on that property. So I can actually get an interest-free loan from CMHC to help me close out on this deal. If it's an existing home, they will go up until 5%, match my deposit. And if it's a new construction, they are willing to go up until 10%. So, yes, you heard it right. The CMHC will basically be able to partner in with you in order for your client or yourself to get your first home. It is basically 5% for existing homes and 10% for newer homes. Let me get my pointer on. Perfect. All right. So they have received so far 10,000 applications that they have already processed through this plan. And it can be really worthwhile if you have a client that can, that is short of funds or is willing to purchase their first home with the help of this plan. So, like I mentioned, it specifically it says first time home buyer. So, who is a first time home buyer? It is someone who has never purchased their home, or it is someone it could be your spouse as well. You or your spouse have not even given a name in a partnership or a property where you use their name to close the property. Even that would basically disqualify you. So you or your spouse did not occupy a home in the last 4 years, or purchase the home, have never purchased the home. Those are the people that will technically qualify for this. If there's a recently breakdown in your marriage or common law partnership, even then your first-time home buyer incentive can reset every 4 years. So what are the requirements of being able to participate in the first-time home buyers incentive plan? Number one is you need to be at least, whenever you're buying the house, at least one of them has to be first-time home buyer. Number two is you must have 5% down payment on your own. The remaining 5 or 10% is being offered by CMHC, but you need the first 5% on your own. Number three is the household income has to be less than $150,000. So you and your spouse's combined income needs to be less than $150,000 in order for you to be able to participate in this plan. And of course, you need to be a Canadian citizen as well as a permanent resident that is living in Canada if you want to look into this strategy. What are some of the conditions? Like we mentioned, the minimum down payment needs to come from you. It could be from your RSP, savings, financial gift, or anything from a immediate family member, for example, like a gift letter. But that first 5% needs to come from you. The remainder is basically mortgage. The 80% of the home is basically mortgaged through the bank, and CMHC will be offering you the first 5-10% along with your first 5% to purchase your home. Just keep in mind that CMHC is only partnering up with you because you are going into this deal with less than 20%. Because once you have more than 20% down payment saved up, this plan will basically not be something that you can participate in, because CMHC want to, get insured, as well as whenever you purchase your first home, CMHC kicks in when you have less than 20% of the down payment saved in. If you have more than 20%, you don't qualify for this plan. So you have to go less than 20% as a down payment along with your partnership, which is the shared equity with the CMHC, in order to take advantage of this program. What are the repayment rules? Now, like everyone knows, whenever you take a loan, you have to pay interest. But the beauty about this plan is there is no interest. It is an interest-free loan from CMHC, so there is no monthly installments like you would make on your mortgage for this. But the kicker is government will share gain and losses in this project. So if, let's assume, you purchase your home and you bought it at $300,000, and with the investment of the government, it would be $30,000, which is 10% ownership. If the house appreciates to $400,000, they will be paid $30,000 their initial investment plus the $10,000 appreciation in the price. So you have to make sure that they become partner to your property. They also you also share the gain or appreciation in your property with them. Let's assume when is the repayment period? The repayment comes either when you sell it, which is when you dispose of the property, or 25 years, whichever comes first. So let's look at an example where there's a shared equity loan, and whereas there is a no loan requirement. How will the monthly payments change? So the purchase price is $512,000. The down payment on both the scenarios is 5% that is put in by you, which is $28,200. CMHC insurance will kick in, of course, because you're paying less than 20% down payment. So on a 5% shared equity loan, you have $25,500 provided from the CMHC, and that brings your mortgage to $479,000. And if you look at on a month-to-month basis, your monthly payment with the shared equity mortgage is actually lower because you put up more down payment, whereas without the loan, your monthly monthly mortgage payment is higher because you didn't have the additional down payment of 5%. So on this scenario, you can see there's a monthly saving as well as there's an annual saving approximately of $1,500 that can really help you, secure your first home or your client to secure their first home. So now, what are some of the updates to the first-time homebuyers incentive plan? In the past, when the first-time homebuyer incentive plan was launched, the annual income that was limit was $120,000. Now this limit is changed to $150,000. So the household income you can have two more parties. They have realized the prices of the houses have gone up. That's why they have increased the household income limit. There's an increased total borrowing amount of 4.5 instead of 4 times the income, which will bring you to $722,000 worth of house. So you can go and buy up to a maximum of $722,000 house or condo in this market, and not go higher than that if you want to participate in this program. This used to be only 505. So, something to think about because it has increased technically. So it's in your favor that now you can afford bigger and more affordable house, which is reflective of today's market conditions. So basically, government is incentivizing you to take less debt and reduce your monthly payment with the help of the additional, $20,000, $30,000 in increase in the household limit. Some of the new updates that were recently announced in June of 2022 were now homeowners will pay back upward to a maximum of 8% of the appreciation per year rather than splitting 50-50. So for example, if my house I purchased for $500,000 and in 10 years it became $1 million, so there's 100% increment in the house value. Does that mean the entire additional appreciation of $500,000 is split 50-50? The answer is no. What they're trying to tell you here is, in the June announcement, is they are only interested in getting an 8% increment every year. It is not compounded. So if you kept it for 5 years, it's 8% return on their investment every year. If the house value has gone up by 100%, right? They only want the 8% per year increment incentive to be paid back. If there's a downfall, let's assume a $500,000 house only was left at $250,000 with the market conditions, they are willing to share a maximum loss of only 8% per annum as well. So an 8% increment or an 8% loss is what they're maximum willing to participate in. They don't want to make an absurd amount of gain, and they don't want to make an absurd amount of loss either on the position. So government is playing pretty smart here and safe. Some of the other things you need to notice here is there are some additional legal fees, appraisal fees, and other property insurance premiums that you may need to be you need to make yourself aware about in terms of when you participate in this plan. This plan is mostly for GTA, Victoria, Vancouver area, and if there's no partial payment required to be made on a month-to-month basis. It's only when the house is sold that you repay all of the incentive as well as the appreciation, 8% upside or 8% downside to the property owners. Any questions so far?
Lakshay, you mentioned here, Sajid. Thank you. Very good information. You mentioned here the changes applies to borrowers in Greater Toronto, Vancouver, and Victoria only, not for other provinces like Alberta.
Basically, this plan was offered on a federal level. It is not provincial level, but there are some income requirements which I mentioned, which is it moved from 120 to 150,000. So those changes are only applicable to the metropolitan areas, like I mentioned.
Okay.
But
because I know it's federal,
yes.
So that's the reason I asked. So
Yeah.
why is only 3 provinces,
Yeah.
2 provinces, Greater Toronto and Vancouver?
Yes. So the plan is still for the entire all of.
So basically,
Yeah.
other provinces, whatever the origin before June 2022, like this 8% increase or decrease happened, that is not applicable for the Alberta or Nova Scotia or other provinces?
Honestly, I when I looked at this perspective, I wish that only Ontario people had joined, so I only focused it on Ontario. But I can check and get back to you. I don't want to misguide or misinform for Alberta and Calgary.
All right. No, okay, fair enough.
Perfect.
Okay.
Thank you. All right. So the last but not the least, how do you apply for this incentive? So there's 2 documents technically you need to fill out. You need to first fill out your shared equity mortgage information package, and the second document is the attestation and consent form. Both of these documents need to be filled out, and then you can take these signed documents to your mortgage broker, who will then submit these documents to the program administrator of this CMHC. Once the application is completed and you are approved, FNF Canada will basically be the one who will release the funds to your lawyer on the closing day. But they, of course, need 2 weeks prior notice of your lawyer's name and all of those sorts of things, so they can release the funds in the time that is given. So a very good program, and I think definitely realtors as well as new first-time home buyers should certainly look into this, as you know, it can make the house, it could really make or break your the first deal that you're trying to do. And that basically sums up today's presentation. Thank you guys for joining in. I have my phone number and my email address here, so if you have any questions, feel free to reach out to me, and I'll open the board now for any questions that you may have now.
Lakshay, because I joined it late, would you mind sending me the PowerPoint for this presentation?
Yes, yes, absolutely. If you can send me an email later on, I'll reply back with the presentation to you.
Okay, Lakshay. Thank you.
Thank you.
Hi, Lux. This is Umesh. For the repayment, if I understood correctly, the repayment is only made when the property is sold. Is that correct?
Yes.
Okay.
Or if the property is not sold for 25 years, then they will automatically ask you to consider disposed of and repay.
Oh, okay.
Yeah. So
Okay.
whichever comes first, 25 years or you sell it.
Okay. Thank you.
Welcome. I think Mithil had a question in regards to Mithil. Can you say that question again?
Yeah, sure. Hey, Lakshay, having a great presentation.
Thank you.
Thanks. I'd like to have the deck as well so we can share it with the team here.
For sure.
So the first question is the 5% that we're getting from CMHC. That would be registered as a lien on the title. That's question 1. And question 2 is whatever that 5% difference is, let's say $10,000, just for numbers purpose, that's essentially being charged at approximately at 8% interest rate. Up to 8%, or is it set at 8%?
So up to 8%, maximum of 8%. So 2 questions. Let me just clarify, and maybe that'll answer a question as well. So this technically is they will be on the title as well. So there's no lien, they will be on the title, so they're partner on the house. Secondly, you mentioned the 8%. The 8% is actually ownership, it's not interest. So 8% on the appreciation. So for example, if the house property the value did not go up, then they are willing to take a loss up until 8%. So essentially it is not 8% interest, it's 8% ownership. So it's not like they have to pay regardless of whatever happens to the house, the 8%. If I were to go outside a second mortgage on an 8%, they don't care what happens to the value of the house. They need that interest. Whereas in this scenario, they're willing to be partner and suffer the loss as well if the house value didn't go up.
Got that. So now asking the question, let's say the first-time home buyer has bought a condo. Condo is about 600,000. He's got 5% for it, which is about 30,000. Remaining 5% or up to 5% basically comes from CMHC. We're looking at another 30,000. So now the ownership of the property is under 2 people's name, person X and CMHC example.
Yeah. Yes.
That's how the on title would get registered.
Everything. Yes.
The second part is you're not paying anything monthly to them, yearly to them. Only when you sell the property, up to 8% of that profit amount is what you give them. So
Exactly.
profit plus the original amount that they give.
Yeah.
Does that make sense?
Correct.
Okay. And after the first 2 years, let's say client now has some money, wants to rent the property out, would it still be considered everything as is?
This is meant for first-time home buyers, so I don't think anyone would purposely pick up the phone and call them that I'm trying to rent this. They only care about when they're disposing off. As long as you're making the monthly mortgage payment, I don't think there is any sort of communication that needs to happen if they start to rent it.
Right. So there's no minimum requirement that the family has to stay in it for 3 years, or the individual has to stay in it for a certain time. For 2 years later, family requirements change.
Most people who are in this scenario, right? They trust the market. What they try to do is they get into their first home. 2-3 years later, they don't like partners on the property, especially when they're living in it. So they would rather sell it, and then when they rebuy the new property, then they can do whatever they want on it. But since CMHC is involved, they wouldn't want to rent it and then let it appreciate to hundreds and thousands of dollars, because that 8% will also bite. They'll rather just sell it in 3 years, buy a new property, and then absorb all of the appreciation themselves.
Got that. And then the last question is, let's say that CMHC insurance that gets calculated. So usually, let's say if I was only going 5% down or 10% down, then the remaining of the mortgage insurance gets calculated based on that. So in this case, we would consider this as a 10% down payment. Is that
Yes.
Then
Yes.
the insurance value would get added up?
Yes.
Okay. Perfect. Thank you. Appreciate it.
Welcome. I think another question from Lachman Balani. Only in the Toronto and Vancouver, and think for less than 150K. Yes, you're right. The 150K house income limit is only for Toronto and Vancouver area. Any other questions?
No, I just WhatsApp you my email.
Perfect. Thank you. Appreciate it. I'll stay around for a couple more minutes if there's anyone that has any question.
So Lakshay, also just if you can remind your viewers as well that this will also be on YouTube as well.
So what I have gathered in this short amount of time is, suppose anybody who has a 5% down, is a first time home buyer, can go for a CMHC loan. So the increment, whatever happens, if it is 100% or whatever, they have to pay within 8%, and within 8% when they are selling the house, when they sell the house.
So, however, yes. So, if there's any profit, they are going to be paying 8% rate of return on whatever the partnership was. If it was 5% that they had put in, then 8% on the investment amount. And it will be for a number of however many years. If it's 8 years, then 8% per year. Once again, if someone has missed the presentation, has raised a very good point that this presentation is recorded and will be available on YouTube as well. And if someone wants to watch it, the first 15 minutes is just, I think, what the presentation was. So you can certainly rewatch it and see if there's anything that you might want to consider or explain to your client on.
Okay, thank you.
All right.
Lakshay, your trainings are really useful.
Thank you. Appreciate it.
Enjoy every minute of it. It's so much knowledge that we gather. I have made a notebook.
Thank you. Appreciate it. So if you guys can continue to join every Tuesday 2 p.m., we'll be sharing more and more information. I really appreciate everyone joining in today. I hope I've answered everyone's question. If there's anyone that is left who needs to, ask me some questions one-on-one, more than happy to, answer them via email or phone call. We have both of them available on the screen now. But yes, thank you very much once again for joining. Appreciate. Have a good day. And for any of the accounting needs, don't forget to call me. Thank you.
Thank you, Lakshay.
Thank you.
Thanks for joining again.
Thank you.
Right, thanks, Lakshay. Thank you.
Bye.